Hey, what's up you guys? Swan here from Swan Things. And today, let's take a deep dive into the EPF's Member Investment Scheme, which allows you to invest part of your EPF savings into approved unit trusts. Now, if you watch my past videos, you'll know that I have very negative opinions when it comes to unit trusts. In fact, I sold off all my unit trust holdings just 2 weeks ago. And yet here I am contemplating whether or not I should make this investment with my EPF savings. Ironic, I know. As contradictory as this may seem, I'll be going through why I still think it might be a good idea to still consider this investment, and I'll also compare the top funds under the MIS scheme. So without further ado, let's begin. The EPF's Member Investment Scheme allows anyone with sufficient savings in their EPF to invest part of that money into approved unit trusts. How much you can invest is calculated as 30% of your savings in account 1 that is in excess of the basic savings set out by the EPF. If you don't want to do the math on this, simply head over to the KWSP website to check how much you can invest. Now, the reason why they put a limit on how much you can invest is to make sure that you still have enough savings in your EPF to safeguard your retirement. After all, that's what the EPF is for. You do have to take note that if you do choose to invest your EPF savings into these unit trusts, this amount will no longer be entitled for any dividends declared by the EPF, and also the return on your investments are not guaranteed. On top of that, if you do sell off these unit trusts, your capital and any profit it generated will be credited back into your EPF account 1. You can always choose to reinvest that portion back into unit trusts, but you do have to take note that applications to take out money from your account 1 for investments can only be done every 3 months. Also, from now until the 30th of April, if you do invest in these unit trusts through EPF's online iInvest platform, you will pay no upfront sales charges. This might seem like a great deal, but honestly, it's okay. I mean, sales charges don't really make a significant difference in the long run compared to annual fees. But hey, it's better than nothing. So now that you understand how it works, you might be wondering whether it's a good idea to invest in this at all. After all, the EPF is a capital guaranteed and inflation protected investment that has a steady track record of good returns. On the other hand, unit trusts with their exorbitant fees that compound over time has a higher risk of underperforming the EPF, or worse, you might lose some of your hard-earned money. So in the next section, I'll be going through the 2 things that you should consider before deciding whether to invest in this or not, which are risk management and potential gain. When it comes to risk management, since the EPF is such a safe investment, it can and should be used as a fail-safe to guarantee you a basic retirement in the case that all your other investments fail. Personally, I will always keep enough money in my EPF to provide this guarantee, and I calculate this number using my retirement calculator. Now, the reason why I don't like to use the basic savings number provided by the EPF is because I don't think that's able to secure any form of retirement at all. The basic savings in the EPF aims to give you 240,000 ringgit by the time you retire at 55. Which will mean that you will only have 1,000 ringgit a month to spend in retirement. By the time I retire, 1,000 ringgit will only be worth about 400 ringgit in today's money. And so I like to stick with my own calculations, which factors in inflation and my personal preferred spending of 2,000 ringgit a month in retirement. And so from this calculation, if I find that my EPF savings exceeds the minimum amount, I will allow myself the choice to invest the extra money. This setup allows me to take as much risk as I want with the rest of the money, because even if all that investment fails, I'll still be able to retire off my EPF. So if you're someone that's uncomfortable with high risk, you can make this calculation to give yourself a peace of mind. Personally, I find this method to be ultra conservative because there is a very low chance that all your investments will completely fail. After risk management, the second most important thing for you to consider is how likely these funds will be able to give you a higher return compared to the EPF. After all, there's no point for you to consider any of these investments if they aren't able to beat the EPF in the first place. When it comes to unit trusts, the biggest downside will be the annual fees. If you watch my PRS videos, I have shown how small annual fees can snowball into hundreds and thousands of ringgits in fees over time. Now, these fees will significantly limit the amount of return you can get, which is why I've sold off all my unit trusts in the first place. However, in that case, I do have the freedom to invest in lower cost, higher performing investments. But for the EPF MIS scheme, you're only limited to two choices: leave your money in the EPF or invest it in unit trusts. And so we must only compare between these two options and consider nothing else. So when I evaluate these unit trusts, I will only look at funds that can consistently beat the EPF by at least 1% for at least 7 years after fees. You'll notice that I pay no attention to risk level at all, because number one, you have already taken care of risks in the previous first step, and two, since the goal of EPF investments is for long-term retirement, you should only focus on long-term performance and pay no attention to short-term fluctuations that are commonly associated with high-risk investments. So after looking at all 280 unit trusts available under the EPF investment scheme, only 24 funds, or 8.6% of all funds, are able to fit in my criteria. Unsurprisingly, all these funds are categorized as high risk, and nearly all of them invest heavily in stocks. But as you can tell, in terms of performance, none of the low-risk funds can ever come close to what you can get with these high-risk funds. Now that you have this ranking by performance, you might be tempted to just pick the best performing fund and call it a day. However, in my opinion, it's better to add an additional layer of security by understanding what these funds invest in. After all, past performance does not guarantee future returns. And so what I look for in these funds are three things: diversification, future potential, and timing. When considering diversification, I am not too concerned with how diversified the fund is in itself, but focus more on how it can diversify my existing portfolio. For example, if the majority of your investments are Malaysian-based, for example, you have money in the EPF, Malaysian stocks, and Malaysian properties, you might want to consider a fund that provides you overseas exposure. This allows you to diversify your risks. In case the Malaysian market fails, at least your overseas investments might be doing okay. It isn't a guarantee, but it's better than concentrated risk. So in this table, I've categorized all the top performing funds by the region and industry in which they invest in, just in case you're too lazy to look into them one by one. The second criteria I look for is future potential. But obviously, I won't be going into this in detail because it can be quite subjective and also super complicated. However, some of you can think of it very intuitively. For example, I think everyone can agree that China, with its large population, will probably continue on its exponential growth in the future. And so it may be a good idea to look for funds that invest in the Chinese market. The final consideration for me would be timing. Now, even though historical performances may look promising, the same rule of buy low, sell high will apply to unit trusts and can make a huge difference in your returns. Although it may seem easy on paper, it can be super difficult or even nearly impossible to find the perfect entry point. However, there really is no rush for you to convert your EPF savings into unit trusts. And so I personally like to adopt a wait and see approach. If and when the market experiences a significant correction, like what we're going through right now or back in March, I will more likely take advantage of those low prices and buy into these unit trusts. Now, this is not to say that you have to aim to buy into these unit trusts at the lowest point in price. Because honestly, if the fund is doing well, chances are the prices will always be moving up over time. So you do have to keep that in mind. If you want to look at these stock charts, they're available on Morningstar or Fund Supermart. And that's all I have for you today. Now, just to recap, I feel like the EPF Member Investment Scheme can be a useful tool for you to beef up your retirement accounts. However, you do have to consider the risk involved and also select the fund that best fits your investment objectives. Hopefully, by ranking these funds by historical performance and categorizing them by region and industry, you can make a better informed decision if you choose to go ahead with the investment. All you have to do is sign up for the online account with KWSP if you haven't already, and then use the iInvest platform to make your purchase. I'll leave a link below on some tutorials posted by KWSP on how to do that if you're interested. As always, smash that like button if you found this video useful, and subscribe to my channel for more investing and personal finance content. Thank you so much for watching, and I'll see you in the next video. Bye!